In this short video, we will attempt to explain how to make a client acceptance decisions and perform initial audit planning. Initial audit planning involves four things, all of which should be done early in the audit. The auditor decides whether to accept a new client or continue serving an existing one. This determination is typically made by an experienced auditor who is in a position to make important decisions. The auditor wants to make this decision early before incurring any significant costs that cannot be recovered. Secondly, the auditor identifies why the audit wants or needs an audit. This information is likely to affect the remaining parts of the audit planning process. Thirdly, to avoid misunderstandings, the auditor obtains an understanding with the client about the terms of the engagement. And lastly, the auditor develops the overall strategy for the audit, including engagement staffing and any required audit specialists. Before accepting a new client, most CPA firms investigate the company to determine its acceptability. They do this by examining, to the extent possible, the prospective client's standings in the business community, financial stability, and relations with the previous CPA firm. For example, many CPA firms use considerable caution in accepting new clients in newly formed, rapidly growing businesses. Many of these businesses fail financially and expose the CPA firm to significant potential liability. The CPA firm must also determine that it has the competency, such as industry knowledge, to accept the engagement and that the firm can satisfy all independence requirements. Many firms evaluate existing clients annually to determine whether there are reasons for not continuing to do the audit with continuing clients. Previous conflicts over the appropriate scope of the audit, the type of opinion to issue, unpaid fees, or other matters may cause the auditor to discontinue association. The auditor may also drop a client after determining the client lacks integrity. Two major factors affecting acceptable audit risk are the likely statement users and their intended users of the statements. The auditor is likely to accumulate more evidence when the statements are to be used extensively, as is often the case of publicly held companies, those with extended indebtedness, and companies that are to be sold in the near future. The most likely uses of the statement can be determined from previous experience with the client and discussions with management. Throughout the engagement, the auditor may get additional information about why the client is having an audit and the likely uses of the financial statements. A clear understanding of the terms of the engagement should exist between the client and the CPA firm. Auditing standards require the auditors to obtain an understanding with the client in an engagement letter, including the engagement's objectives, the responsibilities, and the auditor and management, identification of the financial reporting framework used by management, reference to the expected form of the extent of the audit report, and the engagement's limitations. For public companies, the audit committee is responsible for hiring the auditor as required by the Sarbanes-Oxley Act. The engagement letter is typically signed by management for private companies. An example of an engagement letter can be found within your text. After understanding the client's reasons for the audit, the auditor should develop and document a preliminary audit strategy that sets the scope, timing, and direction of the audit that guides the development of the audit plan. This strategy considers the nature of the client's business and industry, including areas where there is greater risk of significant misstatements. The auditor also considers other factors such as the number of client locations and the past effectiveness of client controls in developing a preliminary audit approach to the audit. The planned strategy helps the auditor determine the resources required for the engagement, including engagement staffing.